Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, and as always, I appreciate you taking the time to join us today. Today, I am thrilled to have Nationwide. They are going to present their latest product. It's actually going to be released next week, but we've been actually waiting for a new hybrid, and most importantly, some of the features that they're going to discuss are some of the top things that most of our agents request. So having a combination of both all in one product, we are super excited to have here. So today we have Alyssa and Charlene, both from Nationwide, and they're going to join us explaining their new opportunities, sales, and the product itself. So with that, Alyssa, you ready to take it away?
Thank you so much for hopping on today. We're really excited to go over our new long-term care solution, and it is new in the marketplace. It's been certainly, we've been waiting for a long time. It is the second in the hybrid space to have a joint option now. So you're going to still see a lot of the things that I'm going to show you today that you already love from the CareMatters products that Nationwide offers with the cash indemnity solution, guarantees. Now you're just offering now an opportunity for what we heard advisors looking for was, hey, we would love a joint option with that cash indemnity option. We know there is another carrier in this market space that does this, and we wanted to add that variation for you if you love that cash indemnity aspect. This now provides you that opportunity. This product launches next Monday, so then you'll be able to see that. You won't be able to see quite those quotes yet until Monday, but hopefully this gives you a nice teaser as to what you will see and the opportunities that you might have when you are working with clients when it comes to long-term care. And obviously being able to give them some form of a discount by being able to cover two individuals. That really wasn't possible before. You had to have two separate individual contracts. So we'll take a look here, and I'll also give you, if this is your first time looking at some of our long-term care solutions, I'll give you some high-level things as well so that you can keep in mind. We'll go over a little bit of planning for long-term care, advantages of linked benefits, how CareMatters Together is different, what it offers in there, some key features, and then choosing a benefit duration, what that looks like, and why you would choose Nationwide in this situation when you're looking at that. If this is your introduction to long-term care, if this is something you're trying to add to your piece of business, knowing that when you are looking at long-term care, Nationwide, Katie, as well as your team, will help you have a better understanding of, it's not necessarily, we're talking about, a lot of clients have that misconception of, oh, I think of it as like a nursing home, and not really as much as an event that you have to plan for. Just like every stage in life, you've gotten them to retirement and planning for income. Now we're looking, how do we protect that income by making sure we can create a stream of income for them that protects that in that case. And long-term care is that missing piece in many people's retirement planning that can really derail what they've planned for because it can be so expensive, and knowing that you can have something that can protect it and provide an income stream in that event, and have all the guarantees of knowing that there's a death benefit if you never utilize it, you can surrender the policy, but if there was an event, that's really where this product maximizes. It's built up a lot of growth for you to really maybe 5-6 times what you've put into it to be able to get that value in there. Also, when you're looking at long-term care, a couple of things you want to look at what it may cover. These are questions you want to have when you're talking to clients is, will it cover, many clients like to stay at home. Most claims start and end at home. But with that being said, you want to know if that's important to your client. Would they like to stay in their home as long as possible? Those help you determine what products might work the best for them. Would they like to be provided by maybe that their family is managing that care, but they're still around, or would they like a family member to provide that care? Would they prefer to be in a facility care? Those are all good questions to know, but also knowing what your policy provides and protects you from, because if you don't know what that goal is, it may end up being that you don't have a solution that may work as best for what they're looking for in that situation. Many carriers do offer a lot of similarities, but I think one of the shining things that when we built our solutions is we saw a lot of need for individuals to help bring down that cost by offering some informal care, which basically means I can hire or have a loved one provide that care. It doesn't have to be somebody that's skilled, but if I do need skilled care, I have a benefit that works in any situation that I may need, whether that's someone I know taking care of me, that maybe I don't have a high need for nurse kind of level care, and it may be, hey, I just need somebody to be here, all the way to skilled help, which could be all the way to a facility kind of care level, maybe it's 24/7 kind of care. That all looks different. There's a variation of it, but knowing that your plan provides that, that's important as well. And the goal of long-term care coverage is to preserve those assets that you've already worked so hard to grow for somebody and leave a financial legacy for them. That's really the goal there. We're trying to make sure we preserve that and that not all of their assets have to go to long-term care, or they have to make choices that they may not have wanted to make if they had another plan in place, and knowing that you have a carrier that can offset that and that insurance comes into play to say, hey, you take on a lot of that burden before it comes into my financial plan. Now, with that being said, you also want to keep in mind a couple of things. When you are planning for long-term care, think of there are general costs where it can come from. It can come from your lifestyle that a loved one's providing it. It can come from income, but then there's that insurance aspect, and that's really that goal. It may come from a combination of these three, because you may not be able, depending on your client's budget and what they're looking for, they may not be able to cover everything in an ideal situation, but knowing that you can pull from different levers is the goal there. Now, where the advantages of a linked benefit comes into place is you may be familiar with some traditional long-term care or life with an LTC rider. Where this one is a little bit different is where I see it as kind of a step up of maybe what traditional could offer, where the goal is long-term care, but you're offering all these guarantees. You're guaranteeing the premium will never change for this individual, that their long-term care benefits are guaranteed, and that there is a death benefit involved so that if they don't utilize this for long-term care needs, that they didn't lose anything in the situation by having a policy in place, where that's something that traditional couldn't offer in that situation, where you could get a death benefit. So those are things to keep in mind, but the real goal is going to be that leverage, being able to get 5-6 times what you've put into that policy in a long-term care growth where it's guaranteed. So that can be a little bit harder to achieve if you're just using the market or your investments, where you might have to now plan for tax for taking out those, drawing down those assets or selling off property, whatever it may be. This gives you a stream of income without having to make those big decisions when you don't know when that may happen. It may not be a good time in the market. It could be a lot of different things. So that's really the advantages of a linked benefit. It gives you that peace of mind and guarantees as well. Now, where CareMatters comes together in this situation, what makes a difference? It's going to give you what you've seen in a lot of suites out there where there's individual policies, but this becomes a little bit more cost effective of a solution, because now you can put 2 individuals on a contract. So if they were already both going to be planning for long-term care, this is a way to bring down that cost by having them both on there, and being able obviously to have the first cash indemnity solution that is in a joint life linked benefit solution. You're going to have more simplicity in the sense that you are sharing a pool, so there isn't necessarily a determined amount for what person can use which and how much of each. This gives that individual the control of, hey, maybe we need it all for one person, a combination of the two. Maybe they decide, hey, we're going to just do half each, and then we'll go into our assets in that situation. But it gives them that time. They have that predictability of knowing what they're getting. The premiums are guaranteed, death benefits guaranteed, and then they have that control of how they can use this policy because there is no restrictions. We are cash indemnity, which means you don't need receipts. You can use it however you deem necessary, and if you have extra funds, if you need to bank that, absolutely, save it. I'm always an advocate of save your benefits, put in a savings account if you need to draw down if maybe next month's expenses are higher, or if you want it out of that policy because maybe you're not sure that second individual will ever need long-term care, it's out of the policy versus in the policy. So you have that control to make that choice and what works best for you. Now, how this works, we're going to that simplicity aspect of, you probably are used to seeing, hey, there's a duration of 2 years all the way to 7-8 years of coverage. So how this works a little bit differently for the simplicity aspects of it, we offer 48 months, 72 months, and 96 months. So basically that means you have, let's say 96 months for you to use your benefit, 96 payments that will come out of this policy. How you divvy that up is, again, up to you. Is it that we're going to use it all on one person or the combination? So you don't have to worry about, hey, maybe we needed more for one of that spouse and one spouse could take over and help a little bit. So they were able to say, hey, we'll use 48 months for you and keep the rest for me just in case. You have that control in that situation. So I want to illustrate how that will play out for you. So let's say, look at one scenario here. We have two individuals, Monroe and Dolores. So he goes on claim first. He uses 24 months of payments. This is a 96-month example. He passes away. She goes on claim 2 years later. At that point, she uses the rest. She has 72 months to utilize it. So that could be one way that could be utilized. Maybe they were saying, we'll just use it as long as we need it for Monroe, but he maybe only needed 2 years worth of it. Or we can look at here, we have Stephen and Michael. They go on claim in that same time frame that Steve goes first. He uses 42 months. So within 2 years of his claim, then his partner, Michael, needed to start claim, and he had 54 months. So it's not necessarily, you may look at it as 8 years, but in this case, they both went on claim in that same time frame. So at that point, 42 months went to Stephen, and then Michael got the remaining 54 months. Or the third example I like to show is maybe in this case, John and Lori maybe was able to provide some of that care, or maybe she already has another plan in place. He uses the full 96 months. That's where she felt that was best utilized. They wanted to cover as much as that cost for John. You could utilize your plan for that. It is completely up to the owners of the contract how you want to determine how to utilize that. You can take it all, or you can take a portion of it, or save it for maybe the other person. But if you'd like to, and that makes best sense for you, then you could do that as well. Now, I will stress before we keep going on, if you guys do have questions, make sure to type them in the chat. We might be able to unmute you as well, but I would try to type them in the chat as well, and we'll make sure that we get to them. Katie might be checking them, and if she needs to jump in, she definitely will, but also we'll address them at the end as well, because I know this is a new solution, so if something comes to mind, please let us know. Now, remember, we do guarantee everything, so everything you're seeing here continues to grow. Death benefit, long-term care, and premiums all locked in. Another thing that I usually get a question on is, will the inflation continue to grow? It continues to grow no matter what. So even if you go on claim and you have an inflation option that you've chosen that continues for a lifetime, that continues to grow as well. We talked a little bit about this as well. I'll give you guys a highlight of it, but I think we kind of addressed it as well. Cash indemnity versus reimbursement. Remember, with cash indemnity, you use your benefits however you deem necessary. So those are the only solutions we offer is cash indemnity. So that means you don't collect receipts and have to send them to us to get reimbursed. There are the other option there that has a joint option is reimbursement. So you do need to collect receipts and bills. You do have to see if the services do qualify, all of those things. So there is a little bit more that you're going to have to do in that situation. But if that is worthwhile, that is an option there. But if you want that control of knowing if my benefit says $10,000 a month, I'm getting $10,000 a month, and I can use it however I deem necessary, that is the solution that you have presented in front of you. We have a cash indemnity solution that allows you that ultimate control to use your benefits how you deem necessary and save whatever you don't utilize if you don't need it, and pull it all out. But sometimes that happens. Maybe 1 month is not as expensive as another month, and being able to know that you can bank it and save it, or if you never utilize it, then it's out of the policy for your loved ones or whoever was going to receive that. So I want to show you some of those key features that you might be looking for as well. So the first question, you're probably thinking, well, how young can this individual look at this solution? So just like our CareMatters 2 solution, you can look at somebody as young as 30. So that may help in a lot of, and that does come up, even though I still say the average age is probably mid-50s when I see a lot of people come and look for long-term care. We are seeing a little bit of shift of younger individuals because they've seen their parents take care of their grandparents, or maybe they were also providing care to their grandparents. So they are starting to ask questions like, what do I do for my own self in this situation to provide that? So you can have this conversation as young as 30. There is going to be a maximum issue age. The 70 is going to be that cutoff range. So it's a little bit higher on our individual policies where you can do 75. But in this case, if you want a joint option, 70 is going to be that cutoff age. We did add a new premium mode, which is 20 pay. So we used to have a pay to 65. So now in this joint option, you have a 20 pay. We saw that there was a need for that, especially for individuals that were maybe 55, 60 that were planning and needed 20 years versus a 10 pay. So you do have that available to you today. And then you can see single pay is 70, 5 pay is 70 as well. That's the maximum issue age. A 10 pay is 70. And then those last two, 20 pay and pay to 100, you'll need to be, there's a max cutoff at 65 to use those payment options. Now, another question that does come up is, well, what if I am looking for, maybe my spouse has a pretty good age gap. As long as it's not more than 25 years, then we're good with that, assuming they get a preferred rating. So I'll go over underwriting in just a second, but there will be a 25-year age gap in that situation if you're looking at that. Now, if one of those individuals is standard, then that gap drops to 10 years that will issue. But where I can see if you have really healthy individuals, 25 years age range can help with a couple of things. I've had that come up with maybe a parent and child. You could do that. Maybe you have two siblings that live together. You could do something like that as well. So it does not necessarily always have to be a spouse. There just has to be an insurable interest. So I have had that come up where, hey, two sisters live together. They are the ones taking care of each other in the situation. This could be a situation for them. So underwriting classes is a little bit different if you have seen our individual policies or what you see out there on the individual basis. So we used to have, or we do currently have on our individual basis, it was, hey, you either have a couple rating or you have a single rating. So in this situation, we still have tobacco and non-tobacco. I want you to think of preferred as if you've already gone through the regular individual policy with Nationwide, that's where preferred is. If you would have gotten a yes on that, that's where preferred falls in. So that's basically up to a table D. So you can get preferred up to a table D in that situation. What we wanted to do with the joint option is extend that underwriting class and be able to add more people than we had previously on our individual policy. So standard means that we will take anyone from those next 4 tables, so all the way to table H. So standard isn't your regular standard that you're thinking of in life insurance. Standard really means you could be as high as a table H in that situation. So that's where we have that age gap where I said, hey, we have to drop it to 10 years because that person is still heavily rated in that situation. But we are now able to take on more risk underwriting than we did before. Now, I will also point out if you end up with somebody that you have 2 individuals on the same policy and they're both fall into that standard subject underwriting class, then we cannot take that case at all. One individual has to be preferred. So that one person has to be able to qualify for a rating that goes up to a table D, if you will. That's what falls under preferred. So you can have a preferred and a standard, but you cannot have 2 standards. Another thing we will be adding as well is decreasing our product minimum. So it used to be that you could only go to $2,500 a month as the lowest starting point. We have dropped it to $1,500. The exception is going to be the 3 states that you see there, South Dakota, Vermont, and Wisconsin. They have minimums that they require us to provide. So those are the 3 states in that situation that if you happen to run clients in that's why you'll see those particular minimums in that case. But this now allows you to have a wider range of conversation because that minimum can start at a significantly lower $1,000 less than it was previously on our individual policies. The maximum is still going to be the same. Not that we see too many of these cases, but if you do have that somebody wants a fairly large policy, your max starting point, you could still add inflation to that, but the starting point would be, hey, $20,833 a month. So you can have a policy that large, but usually we don't run into too much of an issue of somebody needing more than that. This is just more of how the product works in itself so that you know, but typically how it will break down in a preferred situation is you have in those 48, 72, and 96 options, the first bucket that you're accelerating is essentially your death benefit. So you may have seen in our previous solution that that's about 2 years. In this solution, how we built it, it doesn't really have a huge impact outside of if you are going to have clients that want to retire internationally. This may come into play, but essentially you have your acceleration of your death benefit portion that's long-term care is 36 months on a preferred status. And then the extension of benefits would be 12 months for 48, 36 for 72, and 60 for 96 months. That's just more of how the policy is designed, but it doesn't really have an impact. They still have their same monthly benefit. It does change a little bit with a standard. It will go to 48 months, which are essentially accelerating your death benefit. Again, this doesn't come into play, and it's not a really big concern unless you are looking to retire internationally. So if you are looking to retire internationally, I'm going to skip ahead and then come back to this page real quick. Let's see. If you are looking to retire internationally, it still works the same as our CareMatters product. You get 100% of that acceleration of your death benefit portion. So you get 100% of that and inflation during that time period. The extension part is what stays and only can be provided in the United States. So when we do design somebody who may retire internationally, we want to look at that differently. So I'm going to go back really quickly and show you. So if this person was standard and got a standard rating and they chose 48 months, they would get that full benefit paid out internationally. But if they wanted 72 months, only the 48 months would be paid. The last 2 years or 24 months of payments would need to be paid in the United States. So we may design that differently. Now, if they were preferred, again, we would probably look at something different here. We probably still, on either case, look at 48 months because we want to get them as much as possible, because that extension portion isn't going to be paid internationally. So we might beef up and put a 5% compound on that 48 months so that we know they're getting as many payments as possible outside of the country. So keep that in mind if you do run into that. It doesn't come up very often, but if you do have clients that are looking to retire internationally, we want to design that a little bit differently for them. So we did touch upon this. You can do those payments that we already went over there. They can be done monthly or annually. We don't have quarter, and there isn't a modal factor to do monthly versus annually, so it should be all divided by the annual amount. What I will stress on this slide that is important to know that is different is if the client does go on claim, their premiums will be waived in full. So before it used to be that on our CareMatters product, and still is, it's only the LTC portion that's waived. In this case, we will waive everything for them if they are on claim. Now, on the one nuance that I will specify, let's say the client is doing a 20-pay, first spouse goes on claim in year 10, is on claim for 2 years and then passes away, then there is technically 8 payments left. If that other individual isn't on claim, they will need to continue those last 8 payments. They aren't responsible for the 2 that were waived. But in that situation that you're still in a payment situation and not both individuals are on claim, that's the only way that wouldn't necessarily work. But if you are on claim, it is waived during that time. As long as one person's on claim, it's waived. Now, this is one I'm really excited about because it is a little bit different for us. So we still have the 3% compound and 5% compound. But again, we want to make this more accessible for a lot more individuals. Now you have the 3% compound for 20 years. So if you are still looking to have inflation, but maybe you're trying to bring down some of that premium cost, you can have that inflation grow for 20 years and then it stops and it stays at that. So maybe it starts at $1,500 and it stops at, $5,000, and they'll stop and stay at that $5,000 that whole time going forward. That could be a way to help design and really build what's maybe more accessible for your clients and help them stay within their budget. So that one I'm really excited for, to give you that option to be able to say, hey, we want to have some inflation, but maybe we want to cut down on that cost and only have it for a specific growth period of 20 years. The guaranteed minimum death benefit on our joint option is going to be 10%. If I'm not mistaken, I believe that's the only in this space in a joint situation that there is a minimum death benefit. So we do still offer our minimum death benefit. Our individual side does have 20%, but on the joint option, we still believe that there should still be something that's paid out. A lot of individuals will use that maybe for burial costs. So whatever your death benefit is, 10% of that is what would be guaranteed. Even if they exhaust their LTC, that's still paid out to their beneficiaries to provide some form of a death benefit if they ended up using long-term care. the potential tax advantages are still there that you're used to. So you do have that opportunity, because we break down those costs, that you're able to get a deduction on the personal side, individual side, or the business side. Individual is still a little bit, I would say, based on how laws are written right now, it's still a little bit difficult to achieve, but it is still possible. So if those are questions you do have and you're like, hey, how does somebody maybe get that? We're happy to go into depth with that for you. It's still accessible for those individuals that have HSAs, that they can use this just as another way for another deduction, so, or distribution from their HSA account. So just like you buy contacts and glasses, you have that opportunity to get some of that premium back in that format. There are some guidelines you have to follow based on your age. There is a limit to it, but that is an option there. And then if you are working with business owners, a lot of individuals, it is a family business, that might be a great opportunity to do a joint contract and get those advantages as well. The elimination period, just like our CareMatters 2, is going to follow suit here. So it is a calendar day. Each individual does have to qualify. So it's 90 calendar days that you would need for an elimination period. So that means you can't do 2 of your 6 ADLs or have a severe cognitive impairment. We do not care if it is that care is provided at home by a loved one during that time, or if it's a formal setting like a nursing home, adult daycare, whatever it may be, or having someone come in to provide that care. It's fine for us however that is met. It just has to be 90 calendar days. And then we retroactively pay those back. So even though you are waiting 90 days before payment starts, we will go ahead and still pay that back in full. So if your benefit was $10,000 a month, day 91, we're processing those 3 months that we missed for that elimination period, plus that 4th month. So you're getting a check for $40,000. So that's one way that you're able to recoup some of those costs that you had during that point, or to set it aside and save for maybe any kind of emergencies that may come up, or to draw down as costs maybe go up, or if you have to make some huge home modifications, maybe you need to buy a new vehicle that will provide a wheelchair, whatever it may be, that is a way that you could utilize that. So that is definitely unique to Nationwide, and that cash indemnity aspect adds to making sure you get that full benefit. We already talked about the international side, but just keep that in mind. That is something that you do have, but you do want to talk to Katie and her team if you do have any concerns of somebody retiring internationally. It just will change the kind of design you may want to do, so that we're making sure we get the maximum benefits as possible if that is a strong possibility or a possibility that they might retire internationally. So there's obviously an easy way of understanding the process and how we can go ahead and I want to go over a little bit of sometimes how the claim process will work. So if you are concerned, there is an underwriting process. We don't do parameds. We do sometimes order doctor records, but we're not doing blood and urine. In this case, you want to know a couple of things. That it is, you will have a digital interview, just like our original solution. If you'd like, you can still do it on a phone interview. Where I do specify where we will do that's a little bit different is if you do want to, let's say it's a borderline case and we're not sure if we would approve, we will order doctor's records. It is still up to you if you say, hey, we don't want to do that. But if we feel like, hey, I'm just not getting a good picture of what's going on because we're not naturally already ordering that first and foremost, we try to go through that from the phone interview and from prescription checks. So we will do a prescription check. And that usually gives us a good indicator of questions to ask, or to see if there is some extra concerns that we need to order doctor's records. So that's the only time that happens. We try really hard not to do that, but if we feel that it may give us an advantage to approve it, we will ask to order them in that situation. Another thing on the claims process, I will talk to you. So on the other end of it, if you do go on claims, we do have a team that does help you and provide you step by step. We'll give you the paperwork. We even go as far as if the doctor can't really fill out all that claim paperwork, we do have a team in-house that is able to order those records and look through everything and determine, hey, everything was documented. We do see that there is a need for long-term care, so that we can go ahead and make that approval. In some cases, that's faster than waiting for the doctor, since it's not usually something they're used to doing, but we try to make this as easy as possible. We also provide you services as well that help you find care in your area, because it is cash indemnity, you do have the choice wherever you want to have that care provided, but we will provide you, it is a service that we offer that you can call us or you can look online, and we'll try to find everything in your area, all the way from adult daycare to facility care, to say, hey, here's a list of everybody in the area. Here are their ratings. Here's their number. These are the things they provide service-wise, so you can find the kind of care that you're looking for if you are looking for more skilled help. But that's something we want to do there for you. Now, when you're working with Nationwide, I'm sure you're probably already working with a lot of carriers that are top of the line, but I want to also know that you have the strength and stability of Nationwide when you're working with us, that we are a Fortune 100 company. We've been in the long-term care space for almost 25 years and been in the business since 1926. So you know you're working with somebody that is committed to providing and keeping their promises to their members, and we are a mutual company as well. And I'm going to see if we have any questions as well, but if I have anything to take away from you for today before we head into questions, is if you have any clients that you're thinking about, jot those names down. So even if you're not sure where to start off, it may be that we start off at the bare minimum of starting at $1,500 a month. Write those down so that you can get them to Katie so she can have those ready, so that when launch comes around, she's able to quote those things for you relatively quickly so you have an idea. And if you were already working with individuals who are already looking at these solutions, please take a look and see if this solution will work best for them. We did price this to be very competitive for you, so that if you are looking at other joint solutions, I highly recommend that you look at Nationwide so that you can see the difference. Katie, did we have any questions in the chat box?
We sure did. Thanks so much, Alyssa. That was fantastic. As she mentioned, please continue to type in. I know we've got a ton of questions here for us. Number one was, can you remind us of the age? What ages can we offer our clients?
Yeah, absolutely. So 30 is the minimum and 70 is going to be the maximum. We are current aged, so just keep that in mind. So if their birthday is tomorrow, but they signed the app today, so tomorrow they're 71, but today they're 70, we can still honor that if they sign it before they turn that next birthday, and get that into us within 30 days.
Perfect. Another question says, regarding the elimination period, how does that work on the joint chassis?
Yep, so I'm going to scroll back here just so we can get through that. It is 90 calendar days per individual. So if husband goes on claim, he has to wait 90 days, make sure that it is a true long-term care claim, and that's where we're gathering records and doing that in that meantime. And if it is a true need for long-term care, it usually lasts more than 90 days. So not something like, because we will get claims for like, hey, I broke my pinky. Usually that's not something. In that case, it's going to need more than 90 days. So that's why it's not a true care claim, but it is 90 days. So maybe that husband goes on claim. He's on claim for 2 years. Then his wife goes on claim. She has 90 days to herself for her own elimination period to show that she does have a need for long-term care.
So this person just responded with, is this elimination period one time per person? So I'm guessing what they're asking
Correct.
is, if somebody would recoup, would they have to meet their elimination period again?
Gotcha. Nope, it's a one time. So once you've met it, and also in that time frame, so maybe they get better after 60 days, but maybe in a year from now they lapse, they would only have 30 days at that point. So it's within like a 730-day period that you have to meet those 90 days. So if it's something that maybe they had a stroke and we're not sure, and they had 60 days met in their elimination period, but recouped enough to not need the long-term care anymore, but lapsed in a year, they could beat those last 30 days. But yes, that in that case, you just have to meet it once. You don't have to come back if you get better and don't need it.
Perfect. Another question should partners, are you requiring married partners, or how do you define partners?
Yep. So how we determine partners is if they are in some form of, in most cases, if it's not, since we are doing joint, so since there's not a couple rating, what we're looking at is if you are a couple that you're in some kind of romantic relationship, like, hey, we're living together, we're splitting bills. I may not be married to this person, but there's an insurable interest. We have kids together, we share a house, this is my lifetime partner, that counts. Now, because we're adding that component of maybe you want to insure maybe a mom and daughter or siblings, there has to be an insurable interest. Maybe mom lives at home with us, and that's what I'm already making sure she's a dependent of mine. I need to make sure I'm providing something that is an insurable interest. Siblings, I live together. Not something like, hey, my sister lives in Colorado, I live here, we want to get a plan together. That wouldn't necessarily count in that situation. But if you're talking purely couples, as long as there's some kind of romantic relationship and you're sharing bills, that kind of thing, that's your life partner, that counts to us. We're not going to sit here and go and pull up marriage licenses and things like that. That's not the spirit of it. The spirit of it is making sure, hey, this person is helping. We have a life together, because technically people who are in those relationships keep each other off of plane longer because they're there to watch out for each other.
So follow-up question on that one is so in regards to partners in general, they must live on the same address.
Yes.
Okay. Next question is, will CareMatters 2 allow a 20-year pay?
CareMatters 2?
Yes. So are you going to, regarding not the Together, but the individual product, was there any chance that they're going to offer a 20 pay?
It is something we are looking at, so it isn't something that's coming at the moment. I will say, just so you are aware, because you may have started seeing things, some changes that are coming on Monday is we are going to drop that minimum to $1,500 as well, and there will be a price improvement on the CareMatters 2 option. But those are the only changes at the moment.
Perfect. Another question is regarding product availability. Is this going to be available in all states?
Perfect. So it is available in all compact states at the moment. So if it's not a compact state, then not at that moment, but they are coming in pretty, actually, I apologize, that's the wrong statement. Yes, it's available in all states other than California, New York. Let me pull up that list really quickly for you. I'm going to forget it already. Sorry, I was thinking of the improvements on CareMatters 2. So let me pull that up for you so you can see that. But I can take another question while I pull that up for you.
So there's another question that says, is the residual death benefit still available?
Correct. So you have 10%. It's not the 20% that you're used to, it's the 10% now. But we are if I'm not mistaken, the only one in this space that will offer a residual death benefit.
Perfect. Another question is regarding family history. Is dementia in family history a knockout?
No, it isn't. If you are showing symptoms of something already, then that would be your knockout, but not if you have a family history of it.
Okay. Can this be qualified with, or can this be funded with qualified funds?
So how you could do that is move it into those qualified funds can go into a SPIA, and the SPIA can pay the premium on CareMatters, but not necessarily inherently where you can just move that in directly into the product. There is a different route you can do that. You would still have to move it into something that can take that. So it would be SPIA to CareMatters.
Perfect.
And then on the screen for you are those states that currently don't have it. So it'll be Arizona, California, Montana, New York, and Washington, D.C. So just keep that in mind.
Perfect. One more question we have here is regarding the international benefits. Can you review that one more time?
Absolutely. So how international benefits work, so we pay 100% of the LTC rider. So I'm going to go back over here just to show you how that will break up there. So the LTC rider, you have potentially 3 riders that are on this product. You have the LTC rider, which is pretty much you accelerating the death benefit portion of it. It's going to take you 36 months to get through the death benefit portion. Then you have an extension of benefits, and that's addition. So if I'm going to keep it simple, the 48 months, 36 months is that acceleration of death benefit, and 12 months is the extension part. So that's what makes the 48 months. If you are going to retire or live internationally, and that's a concern, what that means is we will pay 100% of 36 months and any inflation during that 36 months. But what we cannot pay internationally is the extension part. And that's pretty common through any LTC policies out there. That's kind of where everyone falls under. We'll accelerate the death benefit portion internationally, but anything else will stay in, only will pay out if you're in the United States. So 100% of the 36 months plus inflation during that 36 months will pay out.
Perfect. Well, Alyssa, Charlene, I think we've covered it all. Oh, here's another question that just came in. Has this been filed in New York or California?
That it has, I don't think they've been, they might have already been filed actually. Yes, they've been filed. It just takes a long time in those states, unfortunately. So just to give you an idea, we just got the second iteration in California and we've had it filed for 5 years. I wouldn't have high expectations of it anytime soon, maybe the next couple of years. But that's our hope, is to get it there, but we just aren't quite there with them.
Here's one last one. I guess we just had
another
one that says, do you still allow parent and child who do not live together to buy your index SUL?
I'll bring that one to Charlene.
I was gonna say, I can jump in on that one. We do. What we're really looking at is, as long as there's an insurable interest. So if that child is going to be taking care of, let's say, mother-daughter, if that is mom's caregiver, the daughter, then we would. That's the biggest thing we're going to look for, is the insurable interest.
All right, ladies, I appreciate it. To everyone who joined us today, I much appreciate your time. And if there's anything else that comes about, you will get a copy of this presentation. But please, as always, again, please reach out. Let me know if there's anything we can do to help, or if there's any clients you're thinking about that we could possibly get some quotes going. So with that, Alyssa, Charlene, I very much appreciate it, and everybody have a great day.
Thanks, everybody.
Thank you.
Thanks, Katie.
Take care. Bye, guys.
Bye.